The depreciation of the Chinese yuan in 2025 will surpass expectations, triggering widespread panic and capital flight in China, predicted by the former president of the investment banking division at China Construction Bank, Zhai Shanying, during a recent program. Data released by Chinese authorities show that in November 2024, cross-border investment income reached $189 billion, while expenditures totaled $234.6 billion, resulting in a deficit of $45.7 billion. This marks the largest single-month shortfall in history and a record for capital outflows from China's financial markets. Independent TV producer Li Jun noted that for the past 2 to 3 decades, China consistently reported trade surpluses. Even in the early 2022, where pessimism over China's economy was widespread, the surplus reached $100 billion. By the end of 2022, however, there was a precipitous decline, dropping to approximately $20 billion. The second quarter of 2023 marked the first time in decades that the figure fell into negative territory, at over $10 billion. Although it briefly turned to positive figures, deficit re-emerged in October 2024 at $25.8 billion and widened to over $45 billion in November, a development seen as a historic turning point. Zhai Shanying commented that capital flight has not yet fully begun. He stated that recent outflows over the past couple of months reflect only the actions of a few prudent individuals. He predicted a peak in 2025, after which the environment for future outflows might be constrained by 2026. Historically, China's foreign exchange reserves surged during mandatory settlement periods between October and the Lunar New Year. During this time, the yuan typically strengthens. However, Zhai warned that the current trend is already alarming, raising concerns about the post-settlement scenario. Zhai further forecasted that the yuan could experience an unimaginable devaluation. If even 1 billion Chinese citizens utilize their annual foreign exchange quota of $10,000, the resulting outflow would reach $1 trillion. He attributed the delayed onset of large-scale capital flight to limited public access to financial information and a herd mentality that amplifies once rumors gain traction. He revealed that the few $100 billion in recorded capital outflow represents only surface-level figures. In the fourth quarter of 2024, Chinese citizens used VPNs to exchange much larger sums into cryptocurrency such as Tether USDT on platforms like Binance. Zhai argued that restrictive policies preventing straightforward access to foreign currency have driven citizens to underground markets. Although each individual has an official annual exchange limit of $50,000, the actual process is riddled with obstacles, whether involving cash or electronic transfers. Zhai described the current trend of capital outflows as being in its early stages, predicting a peak in 2025. He noted that public sentiment in China is still influenced by a combination of misplaced optimism and fear of losses. However, once the majority perceives a long-term trend of yuan devaluation, the demand for foreign currency will accelerate dramatically, leading to a flood of outflows. China's foreign exchange reserves, often cited as exceeding $3 trillion, are misleading, Zhai claimed. These reserves include $2.5 trillion in liabilities, leaving the actual usable amount at approximately $700 billion. With monthly deficits of $45 billion, the reserves are rapidly depleting, raising questions about sustainability. While the CCP touts China as the world's second largest economy, the yuan remains non-convertible globally. Zhai suggested that the CCP reluctance to allow free exchange stems from fear of mass conversions of yuan into foreign currencies, reflecting public distrust in the regime. In recent years, the People's Bank of China has facilitated large-scale yuan to Hong Kong dollar exchanges, effectively depleting Hong Kong's foreign reserve. This, Zhai argued, represents a seizure of Hong Kong's century-old economic foundation. The 2024 CCP Economic Work Conference revealed troubling signals with no mentions of core revenue-generating industries. Unlike previous years, which identify sectors such as manufacturing technology, this year's report highlighted only the Hainan Free Trade Port and artificial intelligence, suggesting a reliance on borrowing to sustain the economy. In 2024, fiscal revenue is expected to total 20 trillion yuan, while expenditures will reach 40 trillion yuan. Of this, 10 trillion yuan will come from local government bonds and 11 trillion yuan from national debt. The report underscored that borrowing has become the primary mechanism for maintaining operations. China's real estate and export sectors are rapidly collapsing, and the latest conference report offers a stark contrast to previous years in its vagueness, reflecting a lack of income. This raises questions about the value of China's sovereign currency when the nation's economic structures lack sustainable revenue sources. Senior journalist Guo Jun highlighted a significant development. The yield on China's 30-year-old government bonds, 1.97%, fell below that of Japan's 2.23%, making it the lowest among major global economies. In comparison, the yield on US 30-year bond is 4.75%, while Germany offers 2.53% and France offers yield of 3.64%. All other European countries' 30-year-old bond yield rates are higher than those in Asia. Guo explained that foreign investment in China, estimated at $2.5 trillion, is largely tied to government bonds. Given higher and more stable returns in the US and Europe, these funds are expected to exit. He concluded that the yuan's devaluation is inevitable, as exchange rates are influenced by supply, demand, and government interventions. While short-term controls may mitigate volatility, the long-term trajectory points to depreciation. The Chinese yuan is expected to depreciate as exchange rates, essentially a price of one currency in terms of another, are determined by supply and demand. While this is the theoretical basis, government intervention remains a significant factor by controlling supply and demand. Authorities can stabilize exchange rate within a certain range. Currently, Chinese citizens are allowed to exchange up to $50,000 annually for purposes such as studying abroad or tourism. However, using this quota for real estate purchases abroad is prohibited. Despite this restriction, China's sizable foreign exchange reserve still enables the government to exert influence over the yuan's exchange rate. However, if the economy continues to deteriorate, especially with sustainable foreign capital outflows, the yuan will face significant devaluation pressure. Guo Jun noted that another factor influencing the yuan's trajectory is the anticipated trade war under incoming US President Donald Trump. Potential tariff increases may prompt the Chinese government to devalue the yuan as a countermeasure. Historically, the yuan tends to appreciate in November and December before depreciating again in January and February of the following year. This pattern presents more favorable GDP figures calculated in US dollars. Guo predicted that the yuan might experience a sharp decline starting in February 2025. The Wall Street Journal's journalist Wei Ling revealed that early 2024 think tanks warned Chinese top leadership that failing to act could push the economy into a deflationary spiral. However, these warnings were ignored and the term deflation became taboo within official circles. Economists have long feared that China's post-COVID economy, characterized by a sluggish real estate market, weak consumer spending, and declining investments, could enter a vicious cycle of falling prices and waning demands, essentially deflation. One internet user described deflation vividly. First, price drop, then people lose jobs and run out of money. Gradually, good disappears, leaving people with even less money, and eventually there is not even food to buy. Sources close to the CCP inner circle reveal that Xi Jinping once asked advisors, "What's so bad about deflation? Doesn't everyone like lower prices?" This dismissive attitude, according to insiders, has made deflation a forbidden topic within policy discussions. At a recent high-level meeting, Chinese leaders acknowledged the need for reasonable price increases but offered no concrete measures to achieve this goal. Many economists argue that difficult yet essential reforms to repair China's domestic economy have been neglected by its leadership. Over the past decade, Wei Ling has reported extensively on China and observed multiple missed opportunities to address economic issues. At each critical juncture, party leaders choose to consolidate state control rather than pursue reforms that many economists consider necessary. Some of China's economic challenges predate Xi Jinping's leadership, but his administration's superficial responses have exacerbated these problems. Some government advisors privately refer to this period as China's lost decade. Over the past 10 years, China's economy has increasingly been dominated by state-owned enterprises. excess production capacity in sectors such as steel and electric vehicles has worsened. Today, China is more reliant on export-driven growth than it was in 2018, leaving it more vulnerable to tariff threats from incoming US President Trump. To consolidate his authority, Xi Jinping has centralized economic decision-making and appointed close allies with limited policy experience. While Beijing has publicly claimed to address issues such as the real estate bubble and local government debt, these promises have largely remained unfulfilled. Policies to boost domestic consumption have been delayed or ineffectively implemented. China now faces mounting debt, a collapsing property market, and has wiped out trillions of dollars in household wealth and a looming deflationary spiral. Economic growth has slowed, foreign investment has dried up, and consumer confidence is near historic lows. The CCP has consistently failed to bolster the most critical sector, domestic consumption. Reports indicate that Xi Jinping views American-style consumerism was wasteful and fears that providing too much support to household could foster welfare dependency. The Wall Street Journal noted that more than 10 years into the Xi Jinping era, it has become clear that much of China's growth under his watch was driven by unsustainable borrowing, real estate speculation, and investments in factories and infrastructure the country didn't really need. Difficult reforms that could have unlocked more durable growth, such as steps to increase consumer spending, were neglected in favor of policies designed to bolster Communist Party control. A Beijing-based foreign policy advisor told the WSJ, quoted, "Xi still believes that the East is rising and the West is in decline. It might just not be a straight line in his view," unquote. Sources close to CCP leadership indicated that Xi sees his top-down approach to managing the economy and plans to position China as an industrial superpower as the best path to surpassing the United States economically. External criticism and changes in global dynamics have largely been ignored. Under Xi's leadership, China is preparing countermeasures against potential tariffs from Trump, including restricting the export of raw materials critical to chip manufacturing, automotive engines, and defense-related products. Beijing is also working to strengthen alliance with developing countries in an effort to pressure the US. Miles Yu, director of the China Center at the Hudson Institute, told The Wire China that Trump may seek a more assertive normalization of US-China relations by revising and reinforcing the Phase 1 trade agreement and demanding compliance from Beijing. Yu stated, "The rise of China itself is not a threat to the United States. It's the rise of China under the control of the Chinese Communist Party that's a threat." As 2025 approaches, the CCP is poised to face the consequences of its economic decision, both domestically and on the global stage.